Hello, this is Jim Ridge and Tom Nunemaker. We are very fortunate today. We have Eli, who is the founder of, and he built VixCentral.com. Before we get started, though, a quick disclaimer. Neither VixCentral.com nor Capital Discussions, a broker-dealer or investment advisors. We don't know your level of risk. Trading options is risky. You should end up understanding all risk before you end up trading. Trades that we're going to end up talking about are a computer-simulated model. While they're believed to be correct, your prices will be vary due to liquidity, slippage, and commissions. And with that, Eli, thank you so much for coming and speaking to us. I ended up contacting Eli about a month ago, and we had been talking, and Eli is the one who ended up creating VIX.Central, originally just for himself, found out a lot of other people ended up doing it. Eli, I'll just do a real quick introduction. Eli studied physics and mathematics. He had started his own, he had worked for the Israeli defense in research and development. He ended up actually founding his own company with a couple of partners in around the biometric space. The company went public. So he has been, a physicist and mathematician by training. He's done a lot of this work, and the volatility products ended up holding a lot of interest for him, as it does for us also. And this was just kind of a hobby that a lot of other people ended up really wanting to be able to do. And with that, Eli, I know I did 30 years. Sorry about that, guys. I did 30 years in a very short period of time.
That's good. Thank you very much, Jim and Tom, for hosting me, and thank you everybody for joining us this morning. So what you see on your screen is the first page of VixCentral.com when you enter the site. And what you see is the VIX term structure, which is basically defined as the value of the VIX future as a function of its time to expiry. So on the bottom, you have the months, December, January, February, March, with December being the nearest expiry and July being the farthest. And you have the values for the futures, so 13.16 and so on. As you can see, if you mouse over any point, you get a pop-up with more detailed information, the bid-ask, the change, also when the future expires and the date to expiry. So all this is very conveniently computed for you, as you can see. And below here we have the VIX, which is the spot price that the futures eventually converge to. Now, just looking at the shape of the graph, one can easily explain why it may be attractive to short volatility. As we can see, the graph is upward sloping. So the farther out you go, the higher the values of the futures. So for example, if let's say we were to short the March future at around 17.5, and everything stayed the same, the term structure stayed the same, so we would come back in 3-4 months, and if the curve would remain the same, then the March future would now be the nearest one near expiry and would be around 13. We sold it at 17.5, bought it back at around 13, pocketed this difference, and the margin requirement is around $9,000 for shorting a future. So on the face of it, it looks something that is attractive to do. Of course, that is the main premise, but there are serious risks involved, and we will discuss them in a moment. Below the graph, you see here this table, which is very important. It shows you two things. It shows you the Contango, which is the difference in percent between the futures. So you have here 1 and 2. The 15.64% means that the difference between the second future and the first future is 15.64%, and in absolute terms, right below it, it's 2.06. This is the number between the second and third future, and so on. Also here you see the difference between the Contango between the 7th and 4th future, which is important for people following ETNs and ETFs that follow the midterm futures like VXZ and so forth. But we'll discuss this perhaps a little later. On the side of the graph, you have additional series that you might be interested in looking at. So just by pressing on a series, you can either make it disappear from the graph or click on it and show it. So if you would like to see the other VIX indexes, for example, VXV, you would press that and you would see VXV. You would not, perhaps you noticed when you mouse over one of the spot lines, VIX, you see also the ratios between the different spot indices. So most people follow the ratio between VIX and VXV, and it's currently 0.81. The rule of thumb is that when it's below 1, it's a good idea it's a good opportunity to short volatility, and it's when above 1, it's not. So we can also remove those, and sometimes it's interesting to look at the high and the low of the day. Let me remove the actual quote now. When you see that the range is relatively small, but in days when there is a lot of movement in the market, it's kind of interesting to see the range of where the term structure was. Today, as we can see, it's not that exciting. One more interesting, a few more interesting things that we can see here is you can also look at the realized volatility, the 10-day realized volatility, the 20-day realized volatility, 30-day. And as you see, there is quite a bit of margin between the futures, the spot, and the actual realized volatility, which again is sometimes an opportunity, meaning that if realized volatility going into the future will remain the same, and the volatility, then the futures seem overpriced or could be overpriced. Okay. So another important useful graph that you can use is the previous close, and you can see how yesterday compares to today. Anywhere on the graph you can zoom in, and then you can see in more detail the differences. Let's move. I'll move on to the other tabs, and at the end, if you have any specific questions, I'll be happy to answer them regarding this specific graph. So about a year ago, CBOE added on top of the monthly VIX futures, the weekly futures. So it seemed interesting to me to put them all together on one graph and see a more fine-grained view of the VIX term structure. The problem with the weeklies is that the bid-ask spreads on them are much larger than on the monthlies, also the volumes. So the information there, I would, until the volumes pick up and the bid-ask spreads compress significantly, I would look at this as something that you should follow, but I wouldn't jump to any specific conclusions based on this data. Just to illustrate the fact that the bid-ask spreads are wide, I added these two lines here, which in gray, and you see that for example, the bid-ask spread here is 15.10, 15.95, and on the monthly, it's 15.2 to 15.25. So again, this is something relatively new to keep an eye on, and hopefully, just like there are ETNs and ETFs that are based on the monthly futures, perhaps some kind of instruments based on the weeklies will will emerge and be popular, and that would help to drive down the bid-ask spread. So the next tab, which I would like to look at, is the one for historical prices. Again, on the bottom here, instead of the month, you have days to expiration, because as you'll see, we want to be able to compare term structures from different dates, times, epochs to each other, and the way to do it is not by looking at the specific month of the contract, but the number of days to expiration. Okay, this is when you click on the tab. Just for when you click on the tab, you see that one of the most extreme cases of what we call backwardation, where the front future is higher than the rest of the futures. So this was from October 16th, 2008, and the front future was at 63.88. Just for comparison, let's add today to this, and you see the difference. Currently, the future front is around 13.15. So this is a huge difference. So what can you do with this tab? For example, a very popular thing people do is just click to show previous trading day, see the term structure from yesterday, and then start moving back, tracing the previous date. You'll get different the term structures on different dates going back. If you want to see the term structures together on one graph, you click the multiple dates per graph, and then continue doing the same, but you see multiple dates on the same graph, and it's easier to compare them. So
Eli,
here. Sure.
This is Jim. Would you say go to, because we talked a lot about how volatility was affected going into the election. Could you go to maybe say September 26th and then do exactly what you're doing, walk us forward day by day so that they could see how the line actually changes as we went into election?
Sure. You want from September 26th?
Yeah. So 26. The thing is that it was relatively steep at that point. There were some bumps in it, but it was kind of interesting. I think there wasn't a lot of effect. And then you'll see what ended up happening, because there was a lot of changes in the polls and things that ended up happening. And I want people to see how skew. And here's what I'm talking: calendar skew right now, or the term structure. How the term structure of the VIX futures changed as we went into the election. We looked at how the skew changed on the S&P 500 options previously with our group, and there was a very noticeable effect that we ended up trading through. But there was also a big change here, and I used your tool to end up taking a look at the term structure going into the election.
Okay. So as you saw, I used the Get Prices field to go to a specific date. And now I'll press the multiple dates per graph again. And now we'll move forward. I'll go to the next date. And you see September 27th was a little down. Oh, there was a little bounce up. And then it went up.
Okay. Now, what you see there, guys, is remember what ended up happening with the market as we went through that. In late September, it looked like the markets were happy because Hillary was leading in the polls. Everything looked very good. Then it came out, Director Comey from the FBI's letter, and then Trump started to end up gaining ground. The market went down. You saw exactly what happened in the steepness of the curve right here. As the market ended up getting more comfortable, the whole steepness of the curve, everything was down. As Trump ended up starting to lead in the polls, it ended up moving higher. Then if you remember on Monday and Tuesday before election, okay, it looked like, Nothing was going to happen with the FBI, and Hillary got ahead in the poll. And then it started to end up coming down. So you can see this. Now, here's the really interesting thing, though, as you see in the election. Okay, and this I found pretty fascinating. It wasn't like there was fear just in the first month. Yes, the level of that curve and the shape of the curve, on the day before election, you can see that the right-hand side of it, probably from month 3 back, okay, looks to be pretty normal. But the first 2 months are kind of bent upward. And so being able to see, how much fear there really is about this event, you can tell from the VIX futures. Look at how thank you, that's exactly what I was showing. See, when the first month, okay, comes up like that in the first month and we go from contango into backwardation, that means that there's definitely fear around an event, but there isn't great fear that the entire world will end up changing the way it did, okay, in 2008, okay, when Eli showed you that first graph. And the shape of this curve, meaning that, I use the term sometimes, Eli, I call it, perfect contango, when the difference between months 1 and 2 is the biggest percentage, then the months between 2 and 3 is the next biggest. And as you look at that table going down on the bottom, when you're in just, in great contango and there's a bigger gap in the first 2 months and then a slightly less of a bit, but still a bigger gap in the second one, it means that everything's, the world has peace, everything is beautiful, the market's going to continue to go up. And you can see as you go through periods of time, you can see basically the level and also the depth, how far out in time of fear there is in the market. It's a great tool to be able to end up seeing that and going through and going back at any time. If I want to go back and see what happened during, the weekend in September in 2008, boom, I can end up going to this tool. I can go back and I can take a look at it. And so it's just, I have found no place on the web where I have as easy and as good a pictorial representation of what I can see what's going on in the market than with this graph. I'm sorry, but I just needed to say that to everybody.
No, thank you very much. It's very helpful. And just to drive this point home, we can see the term structure around November 9th, just after the election, and today. So basically, except for the front end, the term structure was the same. As Jim was saying, nobody was expecting the end of the world, but there was a spike in near-term volatility, or not a spike, but it was higher because people were worried about a specific event, which was the election, and now people are much less worried, so the front end is down, and we have a much higher contango. One more example I wanted to show here is regarding the shape of the graph. Let's go to August 2014 to the 14th.
Ooh, a lot of people are going to have fear about this one because we had a lot of traders that this was a tough time to end up trading as we went through.
Right, but so you see, I added the term structure today versus the one in August 14th, and I call the one that we had then a complacent term structure. You see that people are pricing long-term volatility much less than they are pricing today, and contango is much less. Basically, the near end is kind of tethered to what the VIX will be at expiration, as we are nearing expiration, just 5 days to it, or a little more. But the far end is what people are asking for longer term protection has gone up significantly because people realized that they were pricing volatility, the longer term volatility, too cheaply at that point in time. So that is another way of looking at the term structure as a complete function and trying to figure out what is the relation between the prices of the near-term vol and the longer-term vol. Okay, so let me move now to the next tab, which is the Contango tab. So this can be a little cluttered, but we will declutter it. What you see here is the contango as a function of time. Let me take out the S4, S7 contango and only leave the front month contango. And period where it's under zero is where it's less than zero. This is what we call periods of acquisition. So we had a significant one in 2011 and shorter ones in 2015. And this year we had a little backwardation beginning of the year, and basically that's it. You can always zoom in and see in more detail what happened. So this was the beginning of the year. And since then, contango has been pretty elevated during some periods, and we've had a few small episodes of very small backwardation. Okay, so let's reset the zoom here. You can, if you are interested in a specific other instrument, or for example, if you want to see how the front month acted during this period, you can click here and see that on the graph. So for example, let's look both at the front month and the 7th month, and you see that in general the 7th month is higher than the front month. But more interesting, if we zoom in, you see that since September 15th, basically, the back end has gone down much lower than the front end, which is always good for contango. Of course, we can also see the VIX spot and so on. So you can play with this and get some information about that. So I think I covered most of the stuff that is relevant, and I'll be happy to answer specific questions if you have any.
Would you just show one other thing? Would you show the tables with the graphs on the bottom? You have a lot of the volatility products.
Oh, sorry, yes.
Yes,
okay. Oh, yes. Okay, so what you see down here is a lot of the volatility products I follow. For example, the VIX, the VVIX, which is the volatility of the VIX, and so on. And then you can click here and see other indices. So if you're, for example, interested in the VXX, so you can see it here. If you click on the graph, you go to the page at Yahoo with more detailed information. So this is very convenient to monitor. I also built another dashboard. Maybe I'll show it. It's basically a very convenient way to view a lot of the graphs together and be able to compare them. So these are the daily movements. Let's make the graphs a little bigger. You can change the size of the graph. And let's say we want to compare what all these instruments or indices are. Let's say we're interested in VXX. Let's move it up here to the corner. You can drag and drop. And then let's compare it. Let's compare what's been going on today to the spot. So we put in and we can see that how VXX acted relative to VIX now, and so forth. So this is also a convenient tool. You can change the time frame. Let's see what happened over the last 5 days. You can change the size of the graphs and so on. Let's see, let's bring SVXY here. So you can see how they move. You can play with this, and it's basically the tool is just a convenient way to view a lot of graphs from Yahoo in one location and be able to better compare between them. So you get there from just clicking Show Dashboard here. So you have either the graphs here on the bottom that you can use, or you can press the dashboard. Anything else, Jim, that I may have missed?
No, that's pretty much. Oh, you can hear me, right? I was on mute there for a second. No, that's pretty much everything that I end up looking at. Like I said, guys, this to me is, if I'm going to look at one place about volatility, this is where I go. Okay. The one thing that Eli and I were talking about the other day was that when you think about futures, a futures contract is exactly, what it sounds like, right? So a futures contract is you have an agreed upon price at some time in the future, and everything can always be calculated, right? If you buy a S&P future, you can say, well, what would be the cost of me actually, borrowing all of the money to buy the 500 stocks? And that would be my risk-free rate. And then I'd say, well, what's the dividend? And the difference between the two would be, here's the price of the cost of carry for the first month versus the second month because of the dividends. If you take a look at oil, you'd have, or any type of physical, right? You have the same type of thing, except for there's no dividend. There's a cost to store, the physical. Here, right, every single one of those futures, can be arbitraged against actually buying or selling the underlying. There's always a spot price or a cash price, right? Realize that there's always a cash price. When you take a look at gold, there's a spot price for gold, there's a futures price for gold. And you can end up basically trading any one that you want. The VIX futures, it's the only future out there where you can't trade the cash spot. Eli, if I give you $1 million, I say, go and buy me this VIX spot. You couldn't do it, right? I mean,
no.
There's just no. I'm sorry. Go ahead.
So theoretically, the only thing you can do theoretically is the following: VIX the calculation is based on a series of options, right? So theoretically, you can go and buy a basket of options and trade that, but in practical terms, it's basically impossible because the bid-ask spreads in these options and the liquidity and so on. So that's why many times you see that's why it's ill-advised to hold a future to expiration, because during expiry a lot of shenanigans can happen. If somebody trades aggressively in one series of options, it can change the value of the closing price. So not a good idea to hold VIX futures to expiry until you know exactly what you're doing. So yeah, VIX is the underlying reason why there is no spot VIX is because VIX is a mean reversing instrument. So basically, if you had the spot and you followed this very simple strategy, if VIX goes up, sell it. If it goes down, that day buy it. Maybe just a little more sophisticated than that, you would be making infinite amount of money, right? So very quickly with little risk. So that is the underlying basic reason why there is no why you cannot really replicate the VIX spot. But theoretically, if you are a really big player and you have great bid-ask spreads and so on, you can try to trade in this large basket of options, but for all practical purposes, it is impossible.
Right, because your bid and ask, right? Your actual
right.
bid would push the prices, or your ask would push the prices. 2 comments. One, guys, I promise you, I did not set up Eli to say that. Eli, Okay, one of my favorite quotes that I use with our guys a lot of times is a quote from Yogi Berra. Yogi Berra is a catcher for the Yankees. He many funny quotes, sometimes stating the obvious, but he did it in such a way that one of my favorite quotes is, Yogi Berra once said, "In theory, there is no difference between theory and practice. In practice, there is."
Exactly.
Okay. So as you were going through this, I'm smiling to myself because that was one of the things when you and I spoke about. This was not a theoretical only site. When you built this, it was so obvious to me that here was a guy who understood the theory, but was putting out enough information to saying, hey, what do I need to actually trade this practically? How can I end going through? And that's why I think it was just so well laid out. As Eli went through, there's no way to actually trade the cash. So you have to realize how all of these ETNs, came out. And by the way, since there was no real underlying security, right? There's no real. It's just if you take a look at the first and the biggest, right? The VXX. Realized what happened. Bunch of sales guys, are sitting around moping, in 2008 because they can't sell everything. Everybody wants to end up getting out. And he goes, oh, man, you know what I wish I could sell? If I could sell the VIX, I could make a freaking fortune. I'd make my sales quota tomorrow. I could call up all my institutional clients, all my big retail guys, and I could just sell the hell out of this. It's like, how come they can't do it? So they went to a bunch of, their back office buy-side guys, and they said, can't you end up making a product for me like the VIX? And they said, well, you can't do it for all the reasons Eli said. And they said, listen, people are stupid. They'll just buy it. Just give me something that I can claim as the VIX. Isn't there any way you can do it? And they said, well, I guess we could use a combination of the first 2-month futures. Well, how would you do that? Like, for example, the VIX, because this is the way the SIBO set it up when they built the formula to calculate the VIX, is a 30-day look forward into volatility. So it's the options that have 30 days to expiration. Well, why can't you just buy a 30-day future? Because they have expiration dates, and every day they get a day older. So just average them. Oh, okay, that'll work. So let's say if there's, we need a 30-day. Let's say if our front month, and let me do the math easy, but say the front month future was 15 days to expiration, and the second month was 45 days to expiration. Well, if I take half of it at 15 and half of it 45, that averages to 30. So that's great. I'll use 50% of the front month, 50% of the second month. Well, what happens tomorrow? Well, that front month only has 14 days left to go. The back month has 44 days left to go. Oh, so what we're going to have to end up doing is we're going to have to sell some of the front month and buy some of the back month, so now that the average is 30 days again. And this is what they have to do every single time in the VXX or any of the single unleveraged volatility products. Now, the problem is that most of the time, as you saw in the graph, most of the time, except for when the market is in extreme fear, that front month is lower than the second month. That means they have to sell something at a lower price and buy something at a higher price. So therefore, there's going to end up being a daily roll drag, meaning every day when they have to do the daily roll, there's going to end up being a drag, and it's going to take the VXX down over time, and you guys have seen the graph and what ends up happening. There's the inverse of it, where there's I guess the most popular one is the XIV. And I like the XIV because there are no options on the XIV, so there's nothing else influencing it. But the problem is that there's still a lot of inefficiencies in the product, right? There's still the fact that there's huge trading costs. There's huge, fees, when you're trading as a percentage, this much of your whole product that you have to pay to the CFE. And so the XIV, you can't simply end up buying it. But when you look at these two things, that there are definitely times when you can take a look at this. Now, I will end up making this other comment, and Eli, I shared, I think, some of this with you. About 4 years ago, I sat down with the next Goldman guy. We had a PhD quant. He was a physicist also. And we went through to try to take a look at how to end up making money on these things. And in the beginning, where the effect of the daily roll wasn't calculated as to the level that it needed to be, meaning that it was a much greater effect over the long term than I think people originally gave it credit for. And so it used to be, when it first came out, all you had to do was go and buy puts on the VXX and you made money. Just buy them out long term. It didn't matter which ones you bought. Okay, we tried vertical spreads. We tried butterflies. It didn't make a difference as long as you were negative delta, and the further it went down, it seemed like I almost couldn't undershoot it. Wherever I'd end up putting my put, it would go even lower. Well, what ended up happening was that you'll see a difference in between the first 2 months. Remember, this is a really important fact. If you take a look at the equity markets, okay, the most liquid and the fastest market is the future, okay, the S&P 500 future. And I'm just going to use S&P 500. From there, what will end up happening is that there are many high-frequency trading firms that will end up arbitraging the difference. If, let's say, the futures go down too quickly, okay, and there's a difference so that they are underpriced, and let's say the SPY, as the ETF I'm going to end up using, it hasn't moved down as quickly. What will end up happening is that the arbitragers, the high-frequency traders, will get everything back into equilibrium. How will they do that? They will buy the undervalued asset and sell the overvalued asset until they come back into line. Okay, this makes markets extremely efficient. The whole high-frequency game meant that there were more and more traders that would end up doing this, and then as it got to be so big, the high-frequency guys just bought faster and faster networks so that they really were competing against one another. And people who did arbitrage by computer or by hand, they don't exist anymore because the high-frequency guys have taken them all out. The reason why I give you this example in the S&P 500, besides the fact that the VIX options are based on the S&P 500, is that I wanted to give you an equity example. In the VIX, since there is no cash or spot way to settle it out, like if the SPY didn't exist, larger companies could actually buy and sell all 500 companies, right? They could do it with the underlyings if they were big enough. Here, I don't care how big you are or how small you are, you can't trade the spot VIX. So when you're looking at the options on the VIX, a lot of people will take a look and say, I don't understand, where the deltas are, or how come this vertical spread, I'm buying the call at the money and then selling the call one strike above it. I don't understand. I would have thought that it should have been close to 50 cents. Why is it trading at, say, 45 cents or 65 cents? And the answer is that the VIX options are actually priced off of the corresponding VIX future, not the spot price. Okay, so there's a lot of nuances, and it really just changes the entire game. And all of these changes, okay, are really driven from the fact that what Eli talked about before, that there's no way to actually buy or sell the spot price or the cash price of the VIX. So that ends up affecting the ETFs are a lot more traded than anything else because there's no other way to end up doing it. The roll prices get affected. The options prices get affected. There's a huge effect on these things that, from what we had seen in our work, probably took about 2 years before they all settled out. And they're priced in a certain way, and the market makers had done the easy money of just buying puts on the VXX or the easy money of just owning XIV. Those days are long gone. They don't exist anymore. You have to end up being a lot smarter. So, Eli, what are your thoughts on it? Any comments or?
No, I perfectly agree. Another problem with XIV or SVXY, which really the preference between them should be based on your tax considerations. XIV is taxed like a regular stock or ETN, and SVXY is a 1256 instrument because it actually holds the futures. So it's taxed a little bit differently. So check it out. What is better for you? But another problem with the XIV and SVXY is the fact that they rebalance every day, right? They are a leveraged ETF or ETN with a leverage of -1. So per day, percentage-wise, they move exactly inverse to VXX. So if VXX goes up 0.5%, SVXY would go down 0.5% and vice versa, but that is only per day, and they are rebalanced per day. So what you have, if you have churn in the market, which means the market goes up and down, or volatility goes up and down, you would get a lot of churn loss in SVXY and XIV. And if you look over a longer period of time, you sometimes see a discrepancy between how much VXX went up or down and SVXY and XIV went up and down. So that's another thing to take into account, right? Just for example, if for some reason or other VXX goes up 150% per day, which can happen, SVXY would go to theoretically -50%, but in practical terms, it would be completely liquidated. There is no coming back from that, right? It doesn't help that VXX will eventually come down. You would lose all your money in SVXY. And if VXX goes up just 100%, 90% that day, the SVXY would be 10% of its value starting the next day, and it would have to go up 1,000% to get back to where it was before. So
this is so important longer term too, right? Because of the logarithmic nature of the mathematics, right? Everybody knows that if you lose 50% of your portfolio, you have to make 100% on what's left to get back to even, okay? And when you have this drag where losses are more painful than gains, what ends up happening, okay, when you have something like that and you're taking a look at any type of leverage product, or in this case, the inverse, the greater the volatility, the actual moving up and moving down, as Eli gave you an example, if it moved up 150%, theoretically you'd be -50%. The actual volatility, something that moves up and down but has a reversion to the mean property, okay, the worse the daily volatility is, the worse that drag is going to be over time. And guys, I don't know about you, Eli, but I do not know of a product in the world that has more realized up and down volatility on a daily basis, but yet still has as much reversion to the mean properties as the VIX.
No.
Right.
That is true.
Don't know any other, right? Don't know any other product in the world. So what we just, and here's why what Eli just explained it, and I tried to end up explaining also why this is so important, is because this is the effect that we just talked about. This is the worst possible index in the entire world that you can ever have, to have the most drag. That's why where you would think that XIV should end up being through the roof. And it's, we should be able to be, we should all be able to buy it and retire millionaires by next Thursday. It doesn't happen, okay, because of this drag.
Right. It's very important to understand. If we look at the actual graph, what did I press? I pressed VXX, no, XIV, okay. So if we go to the long-term view of it, you see what can happen. Takes a long time to recover. What else did I want to say about this? Okay, so I mean, it's also fair to say about XIV that if you have long stretches of time where volatility mostly comes down, you're going to have a compounding effect also. But these episodes are rare and usually happen only after you've had a big spike. So if you do want to consider a position in XIV, just a bear position without anything else, it may be a good idea to look at it after volatility spikes. And historically also, after spikes and after the term structure is back in Contango and out of backwardation. And then it's a good period to look at XIV.
So Eli, last night I had dinner with both my son and his future wife, my future daughter-in-law. They're both doctors, and they ended up asking me, well, okay, how about this thing? You tell me about the volatility profit. And here was the advice that I gave doctors who don't know anything about trading. I said, if you want, okay, you can do this. After you see on the 6 o'clock news 2 nights in a week about how badly the market has sold off, you can take the money that you've saved and you can start to dollar cost average into the XIV over the next month. Okay, that's the way I explained it to a doctor who doesn't know anything. Okay, when it's absolutely horrible, okay, and you know the thing is that if they're talking about how the market sold off on the 6 o'clock news, you know the markets have gotten crushed. Okay, and you know that XIV has gotten crushed. Did you hit a bottom? No, I don't know when the bottom is going to end up being. That's why I want you to dollar cost average over the next month or two. So, and I've gone back and I've taken a look at it. Very, very super simple strategy, but oh my God, does it work?
Yes. It's, the problem with the strategies is that you may be sitting on, with your hands folded for a very long time, waiting for this kind of opportunity. So you need you can wait a year, 2 years. It can be.
Oh yeah.
So you need a lot of patience regarding. Yes, regarding that.
This is the structure right now that and I would end up calling it the term that I end up using, and I'm not really going to care too much about months 7 and 8, but this is what I use the term perfect contango, because if I look at the contango percentage going from left to right, taking a look at the difference between month 1 and month 2 at 16%, and then months 2 and 3 at 8.86%. You can see each time that I go to the right, it's still a positive number. The first number is pretty positive. That's a big, big number. And as I go to the right, every one of the numbers becomes smaller and smaller and smaller. Okay? When you have this type of structure, I will tell you that most of the time, the markets, there's not a care in the world. There's, peace and prosperity has broken out across the globe. Everything is good and the markets are going high. And you can see that we're melting up at the way that we're working with now.
Yes. No, it looks kind of quiet, but the term structure can change on the dime, right? And the losses or gains from Contango per day are small. Even if you have a large Contango like 16%, then theoretically, if you had, not theoretically, but I don't know exactly this month, but in general, you have between 20 and 22 trading days per month. So a good rule of thumb is you take the Contango divided by the number of trading days. That is how much VXX just from Contango will lose per day. So let's say it's 1.5% or something like that. But that is really, that can be dwarfed completely by a violent move in the term structure. If suddenly from what we have now, it would jump to what we had in 2008, right? And this is not a black swan scenario in the sense that it's not something that we cannot imagine. If God forbid we have a dirty bomb in New York, or the Russians go into the Baltic states, or there is some huge catastrophe in Europe, or anything like that, right? These are not things that are beyond imagination. These are things that we can very well imagine. We can easily get something like that. So my philosophy has always been, you need to be very careful when you're trading with these instruments, and preferably make trades where you know exactly how much you will lose if the worst case scenario happens. And that is one attractive thing about XIV. You can never lose more than the money that you invested in it. In VXX, for example, or UVXY in these scenarios could have gone up, 400% that day or even more. And maybe, who knows, with the bid-ask spreads, could have been much worse. You never know if you have somebody else on the other side of the trade in these scenarios. So just a word of caution.
Very, very, very important, guys. Please listen to those words of caution. One of the things that I've always seen in this, one of the first places where you'll see concern is in the term structure of the VIX options. Okay, I've told some of you guys, I've done some consulting work for some high-frequency trading companies, and while I never saw any of their actual trades, I will tell you that their commissions on the VIX options and on the VIX products are the highest that they end up paying. This is what they're trading more so than anything else, because if that dirty bomb goes off, or if whatever it might end up being that causes fear in the market, you'll see the difference in the VIX futures. Why? It's the most liquid, one of the most traded, one of the most leveraged products out there. And so the high frequency guys or the algo guys can get to this, and this is one of their products of choice. So when you take a look at, and this was another point, okay, Eli, I just want to stress that you ended up making sure everybody got this. When you talked about the roll effect, you may end up saying, oh, look at the roll. I'm getting, 15.93% per month. So if nothing happens, I'm going to end up making, almost 16% this month simply by owning the XIV. Not going to happen, because two things. Number one, okay, as Eli said, he gave you the daily roll, not the monthly roll effect. Why? Because you're only getting paid for one day at a time. What happens if something ugly happens in the market? That 16% advantage can end up turning to nothing or even negative in a heartbeat if something ugly ends up happening. Okay, so you can't end up assuming, okay, that you're going to be able to end up collecting this much money on a ongoing basis simply by owning XIV or shorting VXX. The problem is that, when you get hurt, and you guys can see it, if you go and take a look at an XIV graph by yourself, what you'll end up seeing is there'll be times when things get really ugly where you lose 50% of your money in a matter of, a day or two. Okay, so it is a dangerous place to end up playing, and you do need to end up being quick, okay, when you decide that, the fear is coming. The problem, by the way, is that as soon as you're starting to tighten up your stops or tighten up your trading parameters, that means you're going to get stopped out a lot sooner. And you say, oh, well, if I would have stayed, I could have made more money. Yeah, that's true, but you also could have gotten killed. Okay, so that's why, you've heard Eli and I, warn at least a half a dozen times here. If you're going to do this, do it with small amounts of money. Be prepared to end up taking losses, because this can end up whipping around pretty quickly.
And one more thing to remember that these graphs do not show, and take this, and I'm telling you this as living history. Maybe some of you also have seen it or gone through this experience, is that not only when things move south, not only not only are there losses naturally, but the brokers change the margins on you. So even if you thought that you are well capitalized and you have plenty of margin in your account, it may turn out that this is not the case, and you will be in a difficult position. So when you plan your position or what you want to trade, think worst case scenario movement, worst case scenario margin, and how do I cope with these two eventualities?
Very, very important point. Thank you, Eli. I didn't bring that up before. That's really important.
And Jim and Eli, did you guys see the questions? There was one earlier about, Eli, do you have any research studies that go along with your data, or do you stick with being just great at providing the vol information?
No, I naturally I trade it, and so I follow what I preach, which is my positions. I always know exactly how much I'm going to lose. And the maximum, I know what would happen with my margins. My positions tend to do spreads on long-term options, because statistically speaking, it's where the odds are in your favor. So that is mostly how I trade. And I kind of have a long-term horizon, basically. So, I make bets for a year or two at a time, but I do it consistently every year, and I know that some years I'm going to lose 100% of my investment, and I'm fine with that because I know exactly how much that is. But on average, over a long period of time, I'm going to make money if the world doesn't become a cesspool. So that's basically the way I trade, and it's based on a lot of analysis that I have done. Now, always backtesting is a very dangerous thing to do, and there is no guarantee that moving forward, what worked in the past will work in the future, and you always have to be vigilant and not to fall in love with any specific strategy, and be willing to change it and accept things when things change. And so I'm all the time doing that, all the time doing continuous analysis and so on. But in my experience, the best, least risky way is to trade through option spreads over options that are longer term.
And that's option spreads on which underlying?
The VXX, XIV, not XIV, there's no options, SVXY, mostly these two. These two instruments. Occasionally, I may also. It has become a little less lucrative, but you can. Not a bad strategy is to trade the future spreads. So instead of being either short or longer future, let's say you sell February. By March, and as the term structure moves forward, you see that the difference goes down from about 1. The difference goes from 1 to 2. So you pocket the difference if things do not change, and the risk is a little lower because you always have some volatility there. So depending on the term structure, this can be also an attractive option sometimes to look at. But the idea is, I think, which is a good rule of thumb, never be in a position where you are nakedly short volatility. It's not a good position to be. So people are attracted to selling UVXY calls or VXX calls because for a long time you can make a lot of money doing that. But when the excrement hits the fan, it's going to be a very bad position to be in. And so if you're in this long term and want to consistently make money, I don't advise doing that.
I one time heard a trader say, you can trade naked and be either long or be short, but especially in volatility products. Being naked and being short can be very embarrassing to you.
Right, yes. So, Eli, before we wrap it up, do you have any future plans you can talk about with VIX Central? What's your roadmap for the future?
That's a good question. I would be happy to get any suggestions for people many of the features that I've added are based on requests from people and things that I use and so on. I've been developing the site for about 3 years now or so. So I've added quite a lot of features. A recent feature has been the weeklies. So always open for ideas. I cannot say that I specifically see something that I would really like to do and haven't done yet, but we'll see.
Well, what we'll end up doing, we'll end up starting we have a thread, or we have what we call our forums, and they're basically message boards, but they're all within. It's not a message board like Yahoo. Tom and I kind of joke. It's kind of like a Yahoo message board without the riffraff. Okay, it's people who are seriously want to trade and serious discussions. And so we'll end up starting a thread, okay, just to end up talking about volatility, talking about VXX. The other thing we can end up doing is that we're going to end up posting this video. We'll give you the link so that if you want to have it, or if anybody ends up wanting to end up knowing more about VIX.Central and having a good conversation about it, this video will be available to you or whoever you'd like to share it with.
Sure, and feel free to follow me on Twitter and send me feedback through the site. My email is eli@vixcentral.com. I'll be happy to answer questions and so on.
Eli, on behalf of Tom and I and the entire community, thank you so much for taking your time and sharing, your experience and giving us just this great volatility trading tool. We truly appreciate all your efforts.
Thank you very much. I'm very thankful for you giving me this opportunity to present to your community.
Thanks, Eli. We hope to have you back in the future.
Sounds good.
Okay, bye, everyone.
Okay, thanks, everyone.